Markets are trading higher. Actually, let's just jump over. We can see on the left-hand side, Russell 2000 up 1%, the Dow up 0.75%, SP500 up 0.1%, and the Nasdaq up over 1%. So looks like it was end of year tax selling. It was a fairly strong year for equities, and I think there was just a lot of people pulling profits off for tax kind of harvesting. And people were getting nervous going into the end of the year, where the market just kind of kept moving lower the last few days, and people were I think, exiting their positions because they were scared they're going to keep falling, and that actually added more to the tax selling. People saying, you know what, I'm just going to get out, lock in my gains. And today now we've got a fresh new year. People are moving into the stock market and buying things up. We did see some panic selling. When we look over on our little panic selling indicator, we had a session and a half of panic selling, which was right down over here. Typically, when we see panic selling, the market wants to move higher, and that is kind of what we're starting to see right now this morning. Now, let's just take a look at the big picture here real quick. Overall, I talked about this in a video a few sessions ago, how I believe we could come into a 35 to 55% correction. And this is our long-term weekly chart of the SPY, and we have these buy and sell signals throughout the market. And we never know which one is going to turn into the start of a bear market. And that's why we have to manage positions. 2022, we got out, got back in later for this next bull market that we're in right now. Although this bull market we're in is showing all the signs, again, that we're in a major stage 3 topping phase, but it is camouflaged because of big, heavy tech weighting. And if we kind of peel or lift the hood to the markets and take a look at the underlying, we can look at this. This is the equal weighted SP500 ETF, the IWM, which is the small caps, and the micro caps. So this is the majority. This is thousands of stocks taking the weighting out more or less of the big heavy techs. And you can see we've had a big correction in price. In fact, we've actually seen the trend flip. When we look at the 30-minute chart over here, our momentum signal gave us an SS, which means it's gone from a oversold uptrend. SS is a sell short, and the market has dropped, and now the bars are red. So the short-term momentum is bearish. We'll see if this market can recover. This is a very kind of choppy market, but when we look at the big picture of this, let's jump to the monthly chart of the overall market. And you can see here we had a spike. We had a kind of a blow off top when you look at this whole sector. Back in 2021, the markets put in a top and then went into a correction. And now we are right back into a double top. And the majority of the markets came up. It pierced to a nominal new all-time high, which I've talked about for the last few years. The markets love to come up and create these spikes and hit a new all-time high, get people really bullish. We have seen this. Everybody's been piling into Bitcoin, into the ARK ETFs, into aggressive stocks. And that is a sign that people are bullish and complacency. This is a complacency move, meaning everybody thinks a new bull market is starting. They all get involved here, and then the market's getting rejected now. And January is going to be a very important month. Typically, if January is positive on the month, we see a positive year. If it's down, we see a negative year. And again, I think we're headed to a very big potential correction over the next little bit. Whether it happens or not, it doesn't matter because we follow price. But we need to be aware that something like this could unfold. Now, if we were to zoom out on this chart or look a little further back, this pattern repeats itself where you put in a high, we have a sell-off, you have a little complacency move, and then you come in for a little double top again, and then we had a big sell-off, a big crash among the overall stock market of the majority of what the majority of stocks are doing. And so we have the same scenario here where we could see a big wipeout in price. If we go back in time to 2008, you can see here we had the market put in a top. It sold off. It had a little bit of a complacency move. It kind of put in a spike high, just like we saw last month. And then we went into a huge pullback. This was a 55% pullback in 2008. So this pattern repeats itself, which we can see here with the overall stages of the markets. I believe we are in a stage 3, which is camouflage, meaning it doesn't look like we're in a stage 3 to the masses, to the general public, but we know a lot more than the general public and what different assets are doing and the momentum. We're in this complacency move just before the market starts to go and sell off for a bigger drop. And the key here is to understand which strategies work in this market condition. CGS, which is our asset revesting strategy, across the bottom, it works across all stages. So it doesn't matter what the market is doing, we can consistently pull money out. The OTS, which is our options trading newsletter, if you go to optionstradingsignals.com, we have strategies. Brian there provides strategies that work through all market conditions to constantly sell and write options to pull money out. And then, of course, TTI, or technical investor, it works until the market puts in this top and then starts to go down. So we're in this kind of sweet spot. We don't really want to be trading sectors. They're all over the place. They last for a couple days or a week or so, and then they reverse and get hammered. So they don't have the big follow through because we're not in a raging bull market stage 2. And that's why the band strategy typically ends, which pretty much came to an end about March of 2021. And so we've been in a CGS, technical investor, in OTS strategy since then, and constantly seeing our accounts push to new all-time highs. Now, if we take a look at just the SP500 futures, you can see we've been in this uptrend. The green bars along the bottom tells us when we're in a bullish environment. These green vertical stacks are when we have cycle lows. When there's bright yellow, it typically means we have multiple cycles putting in a low, which can create more of standout lows in the market. We had a standout low over here. We've got another little short-term cycle cluster standing out low here. But overall, the trend remains up. We're bouncing up the 50-day moving average, up the blue line. And we continue to just be hanging on by a thread to this trend. Now, if we were to flip over to the Nasdaq, we had a trend exit over here. The market closed out. Technology stocks, growth stocks struggling a little bit as the end of the year, profit taking, and that's where I think most of the selling was taken. And so it kind of killed that momentum. We're waiting for a potential new signal to generate. If we look at the SP500, which we remain long, it actually had a trend exit signal on the previous trading session 2 days ago. By the end of the day, it actually recovered and is still holding this trend. As I mentioned on Monday, we are on the brink of another leg higher, or that could last a couple weeks, or the trend ending and we start a bigger correction and things could get pretty ugly. The key here is understanding our whole strategy. We get into assets that are rising. So we've been holding the SP500 and we've been holding it ever since we had a sell signal in bonds. We got out of bonds, moved into stocks, and bonds have sold down like 10% or so while the stock market has been moving up. And so we moved into the SPY. We also moved into the QQQ. We hit a 3% target. We hit a 10% target and closed out our position with a nice gain where our counts are hitting new all-time highs for CGS. And we're sitting pretty. We have a little exposure to the SPY. So if this market does want to push or bounce a little bit higher, we can squeeze more out of it. But we're just collecting daily interest and monthly dividends with the balance of our account. Because this market is on the cusp of selling off and weakening, and that's why we keep trimming our profits, moving our stops up. Now, a few days ago, I talked about how the SP500 is holding up, but how dividend stocks are very dangerous. A lot of you really connected with the dividend. A lot of you are holding, most of you, if you're an investor, especially have an advisor or use the old strategy, which is hold dividend blue chip stocks and energy stocks that pay dividends, you can see how the SP500 really has only pulled back a little bit from the high. When we look here, it's down about 3.7%. Whereas if you were holding dividend stocks, and this is why most investors are wondering why they underperform, dividend stocks are down roughly 9%. Huge, 3 times more. Supposedly the safest asset class stocks are down 3 times more than the stock market. I've gone into the detail why. A good chunk of this is because energy stocks have been floundering, which are big dividend paying. They're down huge, down like 16%, 15%. I'll go into that again in another video and go more into detail. But if you hold a lot of dividend stocks, this could be the year you get absolutely annihilated, which most of you know because you've been following me for a while. And hopefully we're going to get a nice rebound in this market, see a rally or pop for a week or two. Trump will come in and then we could see the market sell off, buy the rumor, sell the news. And we'll just have to see how the month unfolds. But be very aware if you're holding dividend stocks, they are breaking down. They do not look good. And we could see eventually a huge collapse in the energy space and dividend stocks going forward. If we go and take a look over at gold real quick, we do have gold and silver up a little bit this morning. In the grand scheme of things, gold has just been doing kind of what we've been anticipating for the last several years since the start of the super cycle, which is rally, pause, rally, pause, rally. It's in a pause mode. It hit our 100% measured move. Those of you who are in our band strategy, we closed out our GLTG trade. Again, I am neutral, thinking gold's going to trade sideways until the stock market tops, or maybe I have a slight bullish bias where maybe it's going to go up, hit these highs again, or push a little bit higher. Overall, the majority of the move is done. When we look at gold from a long-term standpoint, it is very clear kind of where we stand in terms of the move. We had the major cycle low using Fibonacci extension. We have the high, the low that came in over here in 2015. If we carry that forward to where gold should be, we hit that 61% extension move. And when we hit that in pause, we almost always go up to the 100% measured move, which we have hit. And now we've seen big selling in gold. So that move is pretty much done. And now we're anticipating it to trade sideways for maybe a month or so, maybe move a little bit higher. But overall, I do believe it is going to correct with the stock market, just like it did in 2008. When the stock market corrects, gold pulled back 34%. It also did the same multi-year pause and then took off just before the bear market as the whole world saw bubbles everywhere. They were concerned about currencies, stocks, real estate. They moved into this physical asset, and that is exactly what we've got going on again here. If we go and take a look at the bond chart real quick, it's up 0.6%. Bonds continue to struggle. This is the long-term monthly chart. We're kind of down in this range. If we just kind of group all this here, you can see we're in this whole range right down here, and it's trying to carve out a bottom. This looks like a bottom, but it doesn't mean it is a bottom. And the bond market just is trying to build a base, but it could continue to make lower lows. We don't know. When Trump gets in, inflation could skyrocket with tariffs. We could see rates continue to hold up or go higher. The market tends to do the opposite of what the masses expect, and people think rates are going down. Everybody's been piling into bonds, anticipating a big rally, but bonds could actually make another lower low. We could go into 1, 2, 3 surges to a low. This will be everyone takes a bloodbath in bonds, and then it puts in a bottoming formation and eventually becomes an awesome opportunity for us down the road, late 2025, and becomes a very good opportunity. But it is a dangerous play here. You are definitely picking a bottom, catching a falling knife, a very sharp falling knife. So be cautious if you're trying to be fancy and pick bottoms and be a superhero. Typically doesn't pay out. All right, let's take a look at this. This is the Magnificent Seven. So I just took all 7 stocks, I add them up, and it creates a price. Now, it's not weighted or anything really. It's just a really rough price, but I like to get a feel for this. And if we were to just use Fibonacci extension to get an idea, we can go from this major low, this standout low in the markets. Actually, you know what? Let's go for this previous standout low. Let's start on the small time frame. We had the first rally up, it took off, and then it had this first pullback. If we carry that forward, you can see we had a very nice measured move where the market ran up. It had its first pullback. Typically, if we go up to the 618 and pause for a couple bars, we're going to hit that 100% measured move. Then it had a little bit of a blow-off move, shot up, and then got rejected. And that the blow-off move is typically what happens when it's a mass psychology play, meaning headline news, the whole world is chasing it. It's FOMO, it's aggressive traders. It is complacency, people thinking they know what they're doing, and they literally buy at the high and then take a beating and bail out. Now, if we were to step back and look at the bigger picture, we can go right back to where the major kind of super cycle for this whole play came out. We go to the high, we come down to this low, and we carry that forward. And you can see here, we had the move up, we had the move down, we came all the way up. We got close to the 618. It had a hiccup before it. It kind of paused here for a bar, got above it, tested it again. So it's definitely definitely a very key pivot area where it got rejected, then found support. And we came all the way up to 100% measured move. And now we have this complacency blow off top phase that we could see these get very rejected and go into another big pullback in 2025 over the next several months. So that's kind of where we are. This was the 2022 bear market phase. I think we're going to see a 2025 bear market phase and potentially more like financial crisis and blow up phase that will come after the mini kind of bear market pullback. All right, so with that said, where the Magnificent Seven go, because they are like the heavyweights that move the entire index, let's look at the SP500 and do the same thing. Let's go from the major standout low here from COVID. Let's go up to the high that we saw back in 2022 and back to the bear market low in 2022 and carry that forward. You can see we have done exactly the same thing. Fibonacci extension. I'm going to do a detailed video on Fibonacci because it really is the most powerful, the simplest way to trade and know where to trade, where to hit targets, where to pull off profits. But we've had the first move up, the first pullback. We came up to the 618. We had a little pause and hiccup. And now we have hit that 100% measured move in December. And now the market's trying to figure out what it's going to do. Maybe we have a little squeeze and blow up here before it sells off and goes into a much deeper correction. It's going to be very interesting. But the move is done in terms of the main upside potential is really kind of done. Just like on our gold chart, how gold had done the same thing. When we look at gold, it had the same Fibonacci measured move. And in fact, let's take a look over at Bitcoin. The Bitcoin chart, very similar. It had a major standout low in 2022. It had this huge run up. It had the pullback, this bull flag pattern. We came up and hit that 100% measured move. This was a little bonus trade. We got long the markets right here as all the signs were telling us this market was about to break out, or maybe it was this month, that bar here. We got in, we hit our first target at 618, which it actually had a little hiccup and pause on the daily chart, and it came all the way up and we sold right at the 100% measured move at 108,700. We pretty much nailed that play for a 40% move in really just about a month. And again, once something has made that 100% measured move, you should really kind of not love it anymore. I talked about this in another video. Once a main move has been done, don't fall in love with it. This is what the problem with most investors. They're like, oh, that was good. It's moving up. I'm going to hold it. But that move is done. We need to let it build a new pattern and then create a new setup for potentially another leg higher, because it could simply, what goes straight up on news and hits a move can come straight back down. And if we go into a bear market, we could see Bitcoin back down into the 30,000 range, even the $16,000 range. I remember talking about Bitcoin back over here when it was trading at something like 38,000 or something. And I said 16,000 was the low. It came right down to 16,000. And I got a lot of heat from that from Bitcoin lovers who only talk positive about it. But the charts tell us what things are doing. This bearish pattern was just as strong as this bullish pattern, very explosive moves. And that's why we took it. It was just kind of, these are very rare when they come on the monthly chart and they're explosive. And this is a mass psychology play. Everyone, including grandparents, are buying Bitcoin now with their credit cards again, just like they were at these peaks. And that is not a good sign. We caught this move. Everybody chased it, and FOMO drove it higher while we were already in position. Anyways, that's really about it. I think the last thing that people need to remember for this year, I think this year could be a very ugly year. Now, I did get some messages from people saying, why are you always so bearish? Can you not have a positive outtake? I'm really always trying to mentally prepare everybody for the worst case scenario. It's best to be prepared for the worst case scenario and take advantage of it than it is to get blindsided and dread downward movements. Downward movements for us are not a bad thing. In fact, they're a good thing. I see it as an opportunity. I see it as a reset for us, for investors. It could be a negative for the economy and for most people, but for us, it's a good thing. I think the key here is to realize that we're in this complacency phase based on sectors that have been outperforming. And I think we're going to be entering an anxiety phase where the market starts to roll over and head down and people start getting margin calls. They start buying this dip thinking, we're going to see this market recover, and then eventually they get into denial and they can't believe we're in another bear market, how much money they're losing, and they can't get out because they've lost too much. Eventually they will panic and get out near the lows. And then of course people hate the stock market forever and they never want to touch it. And they hate their advisors. They hate themselves for losing money. So this could be a very, very negative year. We're all part of this, the newsletter. So this is all an advantage. What most people go through here, we actually go through the optimism phase where when people are getting nervous and anxiety, we're like excited. We're like, here comes a bear market. This is going to be a huge opportunity. People are in denial how much they're losing. We are in full belief that we're in a bear market and how much we're making. People are panicking, and we are having a huge thrill and a move to the upside, making as much as we possibly can. And of course, as people are getting angry and depressed about their life and retirement, we are in this euphoric phase knowing the stock market is getting close to a bottom, and we're just milking it for as much as we can, knowing it's going to be an amazing opportunity to actually buy into dividend stocks and ETFs and real estate and buy businesses and even, just fun toys, as you know, we all want interesting stuff. So that's kind of where we're at, and we'll see how the year unfolds. January is going to be a huge month in terms of telling us which way this year is going to go. And I'll probably do a video on how to read the January charts and expectations. So that's it for now. Talk to you soon. Bye-bye.